Good morning, traders. How you doing? Welcome to Option Pit State of the Market. We've been doing these since since the tweeting frenzy. So we'll give you a little market action and also what we're doing. And of course, it would help if I would share my screen with you so I could do that. For those of you who caught the ticker highlight show on Monday, it is free. It's free. It's free. And I sold some of the calls that I had there and made some money. Look at that. I think it's 5 in a row. I have to say I can't take any credit for please turn off TE. I don't know what that is. Anyway, lost my trader shop. Anyhow, that was Leisha's pick. And she did a good job. And I'm trying to figure out a little bit more about that stock because there might be something to all this drone action. There might be more in the news, social media, things like that. So stay tuned for it anyway. Also, I don't know, more radar-like stuff. And also tonight, check out at, I believe it's 4:00. Check out the zones with Vaz if you haven't done it. That is growing like gangbusters. She's doing live classes now once a week, and people really like it. All right, so today we're going to talk about skew in the market. I'm still bullish. I still think we get to 6,000 this week. The reason why is we don't sell off. So I'll just give you my quick little review here. What do you notice? We're back in a buy every dip thing again. We definitely had this issue here, but this almost was entirely manufactured because of the tariff thing. And it looks like there's going to be some tariffs, but they're not that bad and whatever. But all I'm saying is we're kind of back to where we were in the area of good feelings we had before. That's what we got. Now, there's also 2 big jobs report next week, so look for some special situations and things like that from us for next week. We have CPI coming out and PPI next week. All right, so for today, what I want to do here is let's talk about what skew is. So if, now here it is. I'm going to give you some art. You guys ready for art class? Now, there are a lot of technical definitions for skew in the market. But I don't care about those right now. It's basically you got different volatilities at different strikes that reflect market sentiment. That's all it is. Oh, I got an alert. What just popped here? Oh, Tesla's going south. He must be tweeting again. I got to tell my pros to close their put spreads. But we'll be okay hopefully we'll be all right for right now. So anyway, different volatilities at different strikes that reflect market sentiment. So what that means is, but however, does everybody in here know what the number one assumption of the Black-Scholes model is? Let's see here. Sorry, I just had to see. Okay. I just got stopped out on right? It's right. The number one assumption is that we know, okay, and this is important for literally Option Pit. We built our entire business on this. Most trading firms, this is how they make most of their money trading. It's the Black-Scholes model. This is the original option model, but basically it's the same assumption. Did you guys know that? So when you look at the option model, all the option prices you see the option model assumes that we know what that annual or short-term volatility is. Now, does anybody here know what the volatility is going to be in the S&P 500 for the next month? Because if you do, I would like you to let me know what that is. Okay? Nobody knows. So how do we get around that? The model wants that number. So how do you produce a volatility if you don't know the number? If you have a model, you're only as good as the inputs of your model, right? Okay, weather forecasting, the virus. Your model is only as good as the input you put in. So the liquidity providers, they adjust volatility per strike. So for you, let's say everybody wants some calls. What do you think the liquidity providers are going to do? They're going to make them more expensive, even if the stock doesn't move. They're going to hike the price. What do traders want when the market goes down? When SPY drops, what do traders want to do? When the market drops, traders want to buy puts. Okay? So what happens is most what we call equity skew is going to look a certain way. So we've got this, right? And I got here a line here. So the Black-Scholes model just wants one thing. The curve looks like that because there's only the S&P 500 only has an average, like a 30-day volatility average is going to be whatever the average number is for 30 days. It's going to show a flat line. The annual volatility will be one number. And at the end, I'll tell you what the annual volatility for the S&P 500 is right now. But for right now, this it's one number. However, options are not priced like that. Options are priced more. Let's use a different color here. Let's use gray. Options are priced more what we call equity skew, like this. Oh, I made some kind of funky curve here. Let me just undo that. Let's try again. There we go. What's called equity skew. So on this axis here, this is volatility. Volatility going up. So this is 0, and let's just call this 50 vol. This is basically SPY skew. Here's your at the money is going to be right here. That's where SPY is trading right now. And this is your strike 0 in SPY, and this is your strike 700. So the volatilities are very high down here and very low above the money. So the market is basically already pricing the fact that retail traders like to sell calls, which pushes the price down because everybody owns SPY, or a lot of people do. So they sell calls against it to generate income. So liquidity providers already priced that in. Even though the market goes up most years, the volatility of calls in the SPY are relatively low. That's why I think most times just call writing strategy in the SPY is kind of crappy. You don't get a lot for it. I think call writing and maybe individual equities can be better, but SPY generally not great. Puts are more expensive. So the market is already pricing in the fact that there's going to be demand on the downside. And there's no, right? So for puts, there is no natural supply. So has anybody ever seen a put store on the corner of their block? Where can I go buy all those puts? Who's the put maker for Tesla, or the put maker for Apple, or the put maker for whoever? Who does that? Who does that put making? Okay, the market makers have to do it. The liquidity provider, right? Citadel has to create that liquidity. Now, on the flip side, is there natural liquidity for call sellers? Where do you get all those calls? What does every pension fund in the world own? Stock. So the reason why here is, why do you care, right? Because, right, the world owns stocks. The world owns stocks. So there is natural supply of calls, but no natural supply of puts. Does everybody understand that part? There's no natural supply of puts. Now here, though, is where things could get, let's just call it, interesting. Here's where things get interesting for you. You're a liquidity provider. And all of a sudden, everybody wants to sell you a bunch of these calls. So this is toss. All of a sudden, everybody wants to sell you, right, the 605 calls. And you own them. You know what liquidity providers do all the time? They hedge. They don't really take a whole lot of directional bias trades. They take the other side of your trade and they hedge. Then what are they going to do? So if I'm long 280 deltas and 280 deltas stock equivalent, I was a liquidity provider. By the end, as soon as this stuff hit my sheets, it would automatically fire a contra stock order to sell SPY immediately against the calls I just bought. So I would end up with something that looks like this. Okay. Now I have no deltas, no directional exposure, and my risk profile looks like this. Now all of a sudden, what do I look like I have? I'm a liquidity provider. I didn't own any puts, but now all of a sudden, what have I acquired? How did I get them? Were they created magically out of thin air? I have puts, what we call synthetic puts, just another term to make everybody miserable. Synthetic puts. So, what's the big problem for the liquidity provider? Is it the fact that you want puts or that you don't sell me calls? Right? Because if you're not selling calls, how are they going to have the inventory to go sell puts? Do you understand how this little kind of song and dance works? So why do you care is because this is reflective, right, of the option prices you pay or the opportunity that could be for you, because as you are not a liquidity provider, you get to pick your price. So sometimes those prices will be much better than others. And one of the reasons is because of skew, right? The fact that those downside puts are priced expensive, those calls are priced relatively cheaply. All of a sudden, when it's not like that, because the market's doing crazy things, nobody wants to sell calls anymore, volatility balloons up, messes the skew up. So you get to pick your price for entry. Right? So from a care point of view as a trader, being mindful of skew, how much, right? How much this line is moving around, the more you want to learn about these type of things, the easier trading is going to be. So this is what I would just call a normal curve, right? Normal, meaning there is a supply of call sellers that the liquidity provider can create puts with, and then they go sell these exorbitantly priced puts below. And that's how Citadel makes billions of dollars a year, and how every market maker made a lot of money. Hans, Leisha, Mark, myself. That was the whole game. Every once in a while, it got very exciting. So, but now, from a retail point of view, what happens all of a sudden if this curve sort of changes, you know, and it does this? Right? Okay, put curve, same. Put curve, same. But all of a sudden, somebody is now upsetting the apple cart, right? They're buying more calls. This could be an Apple, Tesla, whatever. So it looks like the market public, everybody is favoring calls. This is generally a tell that a stock could be going up. Could be the SPY, could be Apple. It could be some of these, little oil stocks, little energy stocks. So that is a tell there. Here's another one. Okay. Let's throw some fun here. Now all of a sudden we have this curve. Okay. What's the red curve telling you? All of a sudden, liquidity providers are not spending as much money on puts anymore. Traders are selling puts, taking profits, right? Crushing those, what we call crushing the vol, crushing the downside. The public paper, remember everybody here is paper, selling those options, crushing the skew line. And these are all exaggerated, right? Because this usually moves within probably one to 1.5 points, depending. So what it is you can now see everything. And here's another hint for you, right? Which is why people are asking about why VIX is important. VIX is just what we'll call the at-the-money volatility for 30-day S&P 500. The at-the-money volatility based on all the vols on the calls and puts. So how skew works and how traders trade it, actually I could just do this, is everything inflects off the at-the-money, right? This is our at-the-money. This is where SPY is currently trading. Okay? This is where SPY is currently trading. And then all of a sudden, all these lines will wiggle up and down in an arc from the at-the-money. So there's a put skew. There's the at-the-money volatility. And then there's going to be a call skew that's also going to move in an arc. So this gives you an idea. Now, how can you guys just look at this and because if you're interested in trading a product, so for instance, there's a stock here right now that I'm interested in. I got to get this. Let's see. Are we down to 320, and I'll sell my put spreads. So here's a stock, right? KTOS. So this is a stock here. So what I want to do is I want to see, okay, if there's a wiggle. Is this line wiggling upward? Is there some more volume? Is there some more interest? How can you okay, here I am. I'm just, I'm a retail trader. I'm trying to figure this out. How can I see if there's any interest here? So you're going to go, okay. Okay, so you're going to go to your option montage. And let's say we're going out to July. And right now, you've got a volatility. I don't know if you guys can see these, but I want to write them up here for you. Okay. You got volatility at the money, trading 46.91 up, ticked up 47. Volatility at 2.5, 46.73, 46.39. Now, all of a sudden, you're getting little upticks here in these out of the money options. Right. So, again, if you take a snap of this, and you're like, okay. Are they going to make these things more expensive? Is there more volume coming in, raising the implied volatility from the at the money? Is there hard dollars buying these calls, taking liquidity out of the market? Right? And that's going to give you a little clue if you think something is happening. Okay, how to use it so you can look at it, right? So, right, the skew can change. Now, again, at Option Pit, we could set up, we set up different types of trades for different curves because essentially it just makes your trade cheaper. Cheaper trades are pay quicker, right? You spend less money, you make your money faster. So skew can change on supply and demand from paper, right? From paper. And paper, we're all paper now. The liquidity provider's the other way. Okay, so why do you care? You're trying to see where the natural supply is and when the natural supply goes away, right? Because you get to pick your entry price. And again, trading like Gretzky, the skew is already there. Skew is for where the market okay. And then you have a change in skew. A change in skew is like Gretzky, skating to the where the puck will be. So skew is already a natural number. Like most stocks have an individual skew. Most equities have pretty regimented skew indexes. But once that number starts to change, that's the market kind of telling you something else is happening because it's affecting the skew curve. It's moving it around because there's supply and demand is overwhelming. Right? So you want to trade like Gretzky, you start to understand when skew changes, right? When you get these changes in prices. The IV is higher in farther in the money no. So right now, what I would say is the only thing you care about in skew, Carol, is the out of the money options. So you care about out of money calls and puts, out of money calls and the out of the money puts, because the in the money stuff should all be the same. So in general, unless the stock is hard to borrow, volatility across the strike is the same. Because if it wasn't, there would be an arbitrage to do. The meaning of the skew index, WA, is it's an index that measures calls versus puts at the 25 delta. So what that means is there's two different things moving. You have the call value moving versus the at the money and the put moving versus at the money. So the skew index for SIBO is okay, but that's not how traders trade it because you've got two moving parts and you only have one index number. So the skew doesn't give you a very clean look. It gives you some, but not all, because you have a put wing and a call wing that move separately. Okay. So is this the only thing to say about skew? No. There are all kinds of, so again, now you can start to see there's trades you can make on this. You buy the cheap options, sell the expensive options, right? Get you much better decay profiles for your trade. So again, lots of ways to use this, but in equities, the simplest way that I can think of is, okay, I see these vols. How much are they really moving and does it matter? Because generally somebody knows something causing these things to wiggle a little bit. All right. And there we go. There's skew. Let's see. Any questions for today? Can the skew go upside down like a frown? What happens, WA, is mostly it kind of gets there, but it's very hard to have the put skew inverted, meaning no, there's no bid for puts. Does the skew curve mean there's good liquidity in the market? I mean, generally, the more liquid, I would say it this way, Sniper, the more liquid markets have more definable curves, what we call slope. So you can actually track, and I have one of my sheets, tracks the slope of the trade. So this line is defined as a slope to the at the money, and there's a slope for the puts, slope for the calls. So this is what I would call an introduction to this concept. It's also an interesting way to look at a lot of zero DTE stuff. If realized vol stays below 6 or 7, that means VIX is headed lower and it stays there. We're in a SPY mode to rally higher, correct? Yes, Robin, I think so. Even though you might not think it, that's what the market's saying. The lower the realized vol gets, the more likely we are to rally. Judith, prefer to watch call or put trends over time. I don't really watch the trends, WA. I just look at my sheet to see how much they're moving away from a norm. So most of the action is in the put trends for the larger indexes, although the calls do move when the market moves. But most equity skew is call skew. So I wanted just to give you here, should I put this beautiful picture in here too, just to give you an idea? That way, when you see the movie and, here we go. Here we go. There you go. All right. So again, giving you an idea of why all this happens. One big, beautiful graph. All right, everybody, thanks for coming to the State of the Market. Check out Vaz and Hannah tonight at 4 o'clock. They're doing things I can't even believe possible, but it's possible. It's happening. Enjoying this market. Okay, 4 o'clock. Links are up top. If you're interested in anything I do, call customer care, 888-TRADE-01. They'll be happy to help you. You all have an excellent day. Some of you I'll see in Rip Zone and Delta Strike. We have a special guest in Delta Strike today. Weekly profit cycles this afternoon. And there'll be more. And if you have requests, you're like, hey, State of the Market, I want a request, Andrew. We want stuff. How do you trade a calendar? Or how do you put on a diagonal? What makes a good one? Let me know. Right? Because as the market starts to settle, we might keep these sessions around. Trade Zone is here today as well with Leisha. Have a good day, everybody. All right.